You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, strap in. It's going to be a wild one. Welcome to TWIFO This Week in Futures Options. My name, of course, Mark Longo from theoptionsinsider.com. Reminding you, if you're not checking out the full network, including the Futures Rundown, very much a sister program to this program, you're missing out. Make sure you check it all out. And, of course, if you want to go above and beyond, you think you're ready to take the leap on over to the pro, only one place to go to get it, theoptionsinsider.com/pro. Awesome pro Q&A this week with our good buddy, Dr. Vix, going deep, super deep into all things volatility. Who doesn't have a question about vol in these markets? Join us over there on the pro, options oddities, the end of the week, live streams, giveaways, all kinds of fun. Theoptionsinsider.com/pro, a great place to talk you off the ledge and maybe talk you into some trading ideas in these wild markets. And you know what? When it's all hitting the fan, when nothing makes sense, when it's dogs and cats living together, mass hysteria in the markets, I can think of only one man to bring on the show to help make sense of it. We put up the D signal, and he responded, none other than Dan the Man Gramza from Gramza Capital Management. He put on his cape, and he's soaring to the rescue. Mr. Dan, welcome to the program, sir.
Hi, Mark. Thank you. What an intro.
How's that for an intro, huh? You feeling pumped? You feeling fired up?
I have a lot to live up to.
All right, then. Let's get down to business, sir. It is time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
Yeah, listeners, it's time for the Movers and Shakers, the portion of the show where we break down what the heck is lighting it up to the light side and to the dark side since our last show over there at CME Group. And Dan, it's another crazy one. I'm sure if you waited 5 minutes, this report might be very different.
I think you might be right, too.
But I guess we got to go with the snapshot we have right now, Mr. Dan. So, spoiler alert, listeners, there might be a tinge of red on the report this week. Oh, maybe I would say, looking at this report, Dan, I don't know, maybe 80-20, maybe 85-15. Does that sound like an appropriate breakdown to you, sir, looking at this chart?
Yes, I think that's right on target.
All right, Mr. Dan, if you're feeling up to it, if you can move that cape out of the way so you can move, you think you can handle a little moving and shaking this week, sir?
Sure. All right. Well, I think we ought to start to the light side since it's not a long list, actually. But if we look at the light side, the top 5, what we have right now, soybean meal up 2.64%. Soybeans up quite a bit today. That makes sense. Nikkei up 2.66%. Number 3, rough rice up 3.67%. Number 2, the Swissy. That currency is up 3.83%. I have a call on Monday with the Swiss bank, and I'm really looking forward to it to see what their perspective is. That market really took off today. Number 1, corn up 4.97%. So a very interesting marketplace. And the ags I find incredibly interesting because of the way they're moving right now. Corn being one of them.
Well, we got the little bit of green that there is out of the way, sir. We could talk a lot about the red. I guess we'll limit it to a bottom 5. I did add a few others in there, Dan, that I'll break down in a little bit. You just have to do the top 5, I should say, or maybe the bottom 5. So have at it, sir.
Okie doke. Number 5, RBOB, which is gasoline. It's reformulated blending of oxygenated blend stock. It's just a way to formulate gasoline so it's supposed to have an higher octane, less pollution. That's what that means. Anyways, that was down 9.89%. Brent, number 4, FSO was down 10.34%. Number 3, WTI, down 11.02%. Number 2, energy sector, down 11.57%. And number 1, to the dark side, was nat gas, down 14.16%. And the thing about it is, last week, it was number 2 to the light side, and it was up 5.11%. So a bit of a switch in nat gas. But if we think about energy and we think about what's going on, I think it's a reasonable expectation for that sector.
And Dan, by the way, our chat is very excited that you're joining us today. And they have set an expectation. They are looking forward to you giving the big adios to something during the show. So just be prepared for that now. If they don't get a big adios, they may riot. I'm just letting you know. All right, let's keep rolling here, listeners. Let's go out.
Okay, well, we'll see.
All right, we'll see. No promises, listeners, but I got a feeling he'll give something. The big adios. If you're wondering where some of your favorites are in our sea of red, it just shows you how much red there is. I mean, you got to be almost at 10% just to break into the bottom 5 this week. The Russell, on the equity side, the Russell 2000 is our closest equity, off 5%. It would actually technically be number 15 if we were going to rake them. Right behind it, we got the S&P Mid-Cap 400 off nearly 5%, about 4.87%. The Dow coming in about number 23, off about 3.9%. And the NASDAQ at number 31. That shows you how much red there is on the screen right now, listeners. Off about 2%. We've also got Bitcoin in there. Looks like it would probably be in the low to mid 20s range. It's hard to read entirely on this chart, listeners. It's off about 3.8% since our last show. Silver also in that downside mix as well. Just a couple of slots north of the NASDAQ. That put it probably around number 29, off about 2.5%. So again, it is a sea of red out there on the screen right now. Of course, we're coming into this show, listeners, on the heel of just massive whipsaws in the market. We saw just whipsaw action all over the place on Monday. And then Tuesday, of course, we started to see some rally. Then we got a little bit of a head fake. And then yesterday, of course, we saw the tariff delay, the 90-day tariff delay, and we saw not quite the biggest rally of all time, number 8 of all time in the S&P, And if you get to modern day markets, outside of, let's say, 1930s, then you're talking really number 3. You got to go back to the wild days of 2008 to find the only other 2 days that were larger percentage movers to the upside. So we're definitely flirting with some historic markets right now. And of course, if you add in the context of a global trade war, which no one alive right now has really lived through, and certainly the modern options and futures markets haven't, then we are pretty much in unprecedented territory. And looking at the CVOL, it does reflect another wild week out there, listeners, because as we're coming into the show today, after the mother of all rallies, or pretty close to it yesterday, at least in the equities, we're selling off. They were off almost 5% today. That has mitigated somewhat. S&P off about 3.25%. NASDAQ off about 4%. Dow off about 2.5%. And our old pal VIX flirting around a 45, 46 right now. So pretty frothy if you know anything about equity vol. But let's get out into the rest of the vol, shall we? It's time to talk a little CVOL. You can run these reports for yourselves. CME Group and CVOL. Let's start in the metals. And yeah, it's just all over the place, listeners. Metals vol spiking right now. 25.12 right now, up 1.25 points just today. It was 1969 for the low. So it's not very often you get about a 5.5 point range in metals vol. That shows you that the game is afoot, that we're treading in some historic territory out there right now. Obviously, a lot of people flock into the shiny stuff right now, with the exception of silver. Silver having some issues. We talked about that yesterday with Carly on the Futures Rundown. But gold setting new all-time highs all the time. I think setting a record this week or last week for inflows into gold funds. So a lot of folks flocking to the king of the shiny stuff, and the vol getting juicy. And now we go the other way in the realm of FX. FX vol getting clobbered, 10.14 off about a point just today. That's a huge move for FX vol in one day. On the week, the high was 11.71, 10.14 right now is the low for the week. So coming in about 1.6 points on the week, which is a huge move in FX. So pinning the needle to the upside in metals vol, pinning the needle, I should say, to the downside in FX CVOL, listeners. So we're already off to a wild start out there, and we're just starting the CVOL rundown. Now we get to the treasuries, and there's been a lot of talk about skullduggery in the treasury markets right now. We'll get to that with Dan in a little bit here. A wild range on treasury price vol this week as well. Again, treasuries not known for being big bastions of volatility. 8.5 in that aggregate treasury price vol right now, off 1.03 points just today. So again, huge move in treasury price vol. 1 point in, let's say, a nat gas or your traditional equity, or pick your poison. Not a huge move in the vol. 1 point in treasury price vol is enormous. Also on the week, a range of 6.98 to the downside, 9.81 to the upside. So you're closing in on about almost 3 points range on the week. That's enormous for treasuries. Again, reflecting that historic atmosphere we're in right now in the markets out there. Ags, one of the few maybe bastions of tranquility in this market right now. Not many to be found. Ag vol right now, 21.19, off about a 1.25 points today. Kind of hanging out in the middle of their range for the week. The low 19.97, the high 22.63. Below it, we have the aggregate commodities CVOL, 39.5, off about 3 points today. The range on the week, 33.17 to the downside, 42.53 to the upside. Almost 9.5 point range on the week, listeners. I mean, what are we? I can't remember the last time we saw that wide of a range in the commodities CVOL. Again, we are reflecting that we are in some very historic times, listeners. Energy CVOL below that, we've seen some wild talk, some things going on with OPEC, concerns about energy demand with the tariffs, all sorts of madness going on in the energy space right now. Energy CVOL, what's going on out there? 57.67, off 6.75 points just today. You might be saying, oh, well, then he must be collapsing. They must be hitting the bottom for the week. Nope. The bottom was actually 47.41, over 10 points below that. And the high 64.44. So almost exactly a 17-point range in energy CVOL for the week. Again, I can't remember outside of some wild OPEC times and maybe when we went negative in crude, a 17-point range on the energy CVOL for the week. That's what we got. And then below it, we have the treasury yield vol. You know, this one's going to be in a list of bonkers things. This is going to be the most bonkers of them all because the treasury markets have been insane of late. Treasury yield vol, listeners, 152.46 right now, off 21 and a half points just today. If you look at the week, this range is almost ridiculous. 129.93 to the downside. Let's just call it 130 for the sake of argument to the downside, listeners. 180.49, so 50 and a half points yield vol range in the treasuries this week. And we're hanging out kind of right in the middle of that right now. So just absolutely wild stuff on the vol front, wild stuff in the markets. I hope you're staying safe and staying sane out there. We got to start picking Dan's brain because there's a lot to get to. I know a lot of you have questions about the wild tumult in the equities. So we're going to start there, listeners.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, time to talk some equities. Dan, I'm not sure if you're aware, but we've been doing a little bit of whipping and sawing out there in the equities of late, sir. We could probably spend the rest of the show just talking about this madness. I'm sure I should say a lot of our listeners want to know your thoughts on just the madness we saw coming into this week, which is already at or near historic levels, and then this week just turning it up to 11, sir. What is catching your eye?
Well, you're right. It's been nutso. It's the way I would describe it. It goes back to the concept, I feel, of a shock fundamental. And those occur about 2% of the time, although this last week, I think a higher percentage. But typically, they don't occur very often. It's because nobody was expecting a dramatic change. And that goes back to the expectations of the market. And that's really what we're dealing with this week. What are the expectations? What's reasonable? I mean, is today reasonable? If I said to you just, let's say a month ago, last time we were together, if I would have said, you know something, CPI, it's going to be down 0.1% for March. You'd say, well, CPI is cooling off a bit. Core CPI increased 0.1%, nothing out of alignment there. So inflation's cooling off. Ooh, that's good. And we have low jobless claims. That came out. That's good. So our labor market's really kind of solid. And now we got earnings coming up. Well, all that sounds really good. And normally the market would be responding to that because then that implies something about the Fed and what the Fed may be doing and what the comfort level is of the Fed to decrease Fed funds rate. But we have that economically, but those are all historical, right? That's backward looking indicators. That's the issue. Even the earnings coming out, those are backward numbers. That's history. The market saying, tell me about now. Tell me about the future. And that's where we get this volatility. Even though economically things really don't look too bad, but in terms of environment, in terms of expectation, in terms of concerns, and whenever I hear the word concern, that means volatility. It also means a market moving on anticipation, not reality. I mean, have we felt the economic impact of these tariffs? No. They kind of got put on, then taken off. So the economic reality is not here. But the market reacts to the anticipation of the future. It reacts to what the expectations are. And that's what we're seeing here. We're not seeing economic reality. We're seeing the anticipation of the future. And if you look at yesterday, I was looking for follow through today. In my video, I mentioned that. A big move? No. Typically, you wouldn't get that because yesterday, I believe, like in the S&P, the market said that big rally. The market said, hey, the delaying of the tariffs for 90 days, it's worth that much in the S&P. It absorbed that news and it said, okay, this range is how much it's worth. The thing that was missing and that I was expecting, and it really surprised me before I went to bed, because, these futures markets trade 23 hours a day. So I get to see how Asia's responding when I go to bed, and how I get to see what Europe has done when I wake up. And what we saw here is not what I was expecting. And it started last night. I mean, if you think about the rally, let's look at the stock market and say, what did we have? We had a big rally on Wednesday. Okay, at the end of that rally, the way I think about it is Asia has not had a chance to respond to that. So if indeed this rally is strong, if indeed there's momentum here, well, Asia should say, okay, we're going to carry it from here. You'd look for that to get stronger. Europe could even be sideways at that point. But that's the environment, I believe, if you're in the United States, that you and I would want to see overnight. We didn't get that. So the concerns are creeping back up again. Well, all right, let's think about that. Is today's break, is today's lower movement in the stock market, is it buyers taking profits? Did buyers come in because it got so cheap? They said, we got to buy it. Actually, if you look at the chart, the last 3 days below 5,000 in the S&P, they were buying it. It's bouncy down there. Okay. So who's buying it? It's of people saying, I got a long-term break and I want to add to my portfolio. They should be holding on to it. And we'd look for follow-through on Thursday. If it's profit-taking, maybe they're going to trim the load on Thursday. And that could be part of what we're seeing here. It also implies, depending how we finish, and I think the way this is setting up, I'm looking for an inside day on Friday. I'm looking for the market to say, wait a minute, I got to catch my breath. Unless we get something new to drive this market, I don't look for much of a move on Friday. I think the market, we got earnings coming out. We got the banks coming out. They could stimulate, but that's history. So they come out and they say, we look great. We had a terrific profitability. Earnings looks wonderful. But what's their outlook? And they're going to say, well, the outlook is uncertain. Because we have what Mark mentioned, a high degree of volatility. And a high degree of volatility implies uncertainty. And uncertainty implies a market that is not going to be sustainable up or not going to be sustainable down even. So I think in the equity markets right now, again, using the S&P, what do we know? We know they're buying below 5,000. And we know as we approach 550, they're selling it. That's what we know so far, the way I look at it. And how are we going to finish today? Well, we broke down to, what was it? It broke down to like 51.30, down in that range. And we're bouncy there. This is today. And we popped right back up. Right now, we're around 53.45. So, even in today's structure, it broke again to the downside. Somebody's buying it. Is because they think it's still a good deal? Is it because 70 countries have said, oh, hold on, let's negotiate? And they know Trump likes to negotiate. And it's interesting, those are the terms they use. Let's negotiate. Let's have a chat and see what we can sort out. The other thing that I find interesting, and Mark, you mentioned energy. And what are these countries? Look at Indonesia. What has Indonesia said? Well, doggone it, we have an imbalance of trade with the U.S. Okay, so we got to buy more U.S. stuff. Well, an easy one to buy more of is energy. And, what do they talk about buying? Nat gas. Let's talk about the EU. EU said, well, hold on, we're going to think about this for a minute before we do retaliate, but we're ready to retaliate if we have to. But, the EU said, well, what can we buy from the U.S. that may balance our trade deficit a bit? They said nat gas. They can use energy. And if their economy is doing well, they're going to need more energy. And nat gas is one that you put right into your system. You don't have to refine it. You don't have to do anything to it. You get to start using it. So my expectations right now, this is a market stopping to catch its breath. I'm looking for an inside day on Friday. And if it does break lower, that may be where the big adios comes into play. But I'm very cautious about getting out. I haven't made much adjustments at all, really, because of why the market's moving. It's not economic reality. It's just uncertainty. And uncertainty, I believe, it's very difficult to maintain a break to the downside without some type of relief. And I think that's what we're seeing now. So I'm excited about this, actually. I can't wait to see how it does unfold. I don't think this is long-term disability because of the economic background. I mean, look at most countries. If you look at their economic situation, it's not too bad. I mean, if we think about China, look at China today. What did China say about their CPI? Son of a gun, it was down 0.1%, just like us. And China has big economic issues coming up. And if I'm Europe, I listen to the chatter from the other countries. They think, doggone it, it's going to cost us more to deal with the U.S. And then China, well, with these U.S. tariffs in place, China may lower their prices. In fact, they have lowered their currency a little bit. And that's the difference between China and the United States and currencies. China manages their currency, meaning they can move it down or up. In the United States, we regulate our currency. We don't manage it. But China has lowered their currency a bit. And if I'm other countries, I'm thinking, geez, China may dump product to us that would be going to the U.S. If they lower it, make it so cheap, then we got to buy it. Doggone it. So that's a concern out there too. So we have a number of variables that I just find in some ways logical and fascinating. Well, so I guess that's my thought here.
Dan, our chat is excited. They got their big adios, which if you missed it, listeners, is if we break through 5,000 aggressively in the S&P, then Dan might think we're heading a little bit down there. Right now, Dan, we asked our audience, is it time to buy the dip? Or was this rally yesterday the mother of all dead cat bounces? And right now, exactly 2/3, a little bit more than 2/3 now, just ticked 67.7% saying yesterday was the dead cat bounce and they're fading this. And about a third, a little less, 32.3% now saying they want to buy this market. Dan, what are your thoughts?
Oh, that both of them are very logical. Because if I think about, if I'm first the idea of buying the break, I wouldn't be against that. The issue is where is this? Who is it? Am I buying it because I want to add to my portfolio long term? That means I'm not going to be looking at it every day to see what to do with it. This is a piece I want to add. Am I a speculator where I'm trying to capture a bit of a swing trade? That's somebody different. If I'm that long-term pension fund, I may be holding this for the next 6 months. My outlook is not the next couple days. My outlook is way into the future. So I think buying the break depends on who it is. And the idea of saying, okay, we're getting ready for another one, another break to the downside. Because remember, it's 90 days. And if a lot doesn't change in 90 days, what would be the reason for this not to go lower? Because that uncertainty bubbles right back to the top. So I think there's good justification, actually, for both of those.
We could break down some, there's a lot of 0-day paper flying hot and heavy right now, as you might imagine, listeners. The E-mini up to nearly 5 million contracts already this week. Rather than trying to parse 5 million contracts, unless you're really excited about some June 5,400, 5,500 call spreads going up for about $54, a lot of that kind of stuff, or the DEES, one of the larger trades going up out there today, individual trades on Globex, the DEES 1,500, 1,200 put spread for $2.45. Unless you want to hear more of that fun, which is kind of fun and silly. We could do that. Or the DEES 7,000s traded $6.50, another one of the larger individual prints going up on Globex today. So a couple of fun things, but I want to squeeze as many products in as we can. I know a lot of you have a lot of questions about what's going on. So let's get going. I see a bunch of you in the chat excited about the equities, but a lot of you also are concerned. A lot of the headlines right now are coming out of the world of rates. So let's head there next.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, everybody, let's get out there to the world of rates. Go into that drop down, cmegroup.com/TWIFO. Click on the rates category. You're going to scroll down a little bit to get there, listeners. Not quite to the bottom of our list, but pretty darn close. And then once you're there, listeners, actually, technically it's interest rates, which is why it's above the metals there, listeners. And then once you're there, you're going to click on U.S. rates, and then from there, you pick your poison. We usually like to hang out in the 10-year. That does seem to be a drive in a lot of the interest out there. By the way, speaking of interest, we talked about it yesterday on the futures rundown. The futures are pretty active. Are the options active in the 10-year? You know they are. 5.18 million contracts going up already. There's not much out there that can really hang with the 10-year volume-wise. Obviously, we just saw the E-mini doing a yeoman's work of putting up a good fight. But at the end of the day, the 10-year is usually the big dog out there around town. Now, Dan, I don't know about you, but when I first rolled into college and I started diving into finance and all that cool stuff, when I got lured away from engineering to the dark side of finance and trading, they taught me that there was an inviolate inverse relationship, Dan, between bonds and equities. They're supposed to move in different directions. And yet, Mr. Dan, I'm not sure if you've noticed, but we haven't been seeing a lot of that of late. In fact, bonds and rates have been moving kind of in lockstep with equities sometime, which is not the way that dance is supposed to go. We're hearing a lot of rumors, a lot of fingers being pointed on some kind of disturbing overnight action in the rates market that really was the catalyst for Trump finally deciding to blink and dial back, step away from the precipice out there. So, Dan, we've seen some wild action in the rates of late. What are your thoughts on the, shall we say, somewhat weird activity we've seen and the impact it's having on the rest of the markets and on the tariffs?
Well, I think when the tariffs were announced, that the 10-year did what it should do. If we think about what happened, we saw the stock market falling out of bed. So that means risk off. It means capital is coming out of the stock market. Okay, well, where does it go? The day that we had tariffs where the market was falling out of bed, does it go to commodities? Typically, it goes to gold. Gold went down that day. Does it go to interest rates? Well, Yes, that's what you expect. So you expect that 10-year note to rally on that. You expect it to flow there. We didn't see that, like you said. We saw it coming down, which means yields were going up. But in some ways, if you think about it, the yield is a reflection of demand. And if we do have that inverse relationship between yield and price. In the United States, although there is a yield futures contract, we typically trade price. So if you look at 10-year note futures, the numbers you see on the right side, those are the price of a $100,000 6% yield futures contract. And that 6%, that yield parameter, is one of the things that you and I want to think about. So if the yield is less than 6% out there, then this should be worth more than the face value of $100,000. So like today, it's around 110 is the number you're seeing there. 100 or 100, around, let's say 110. That means it's worth, the dollar value is 110,000. Each full point is $1,000. Okay, so these numbers where it's trading tells us that it's worth more than 100,000. It tells us that the yield out there is less than 6%. And when money comes in, capital flows towards the interest rate markets, those buyers come in, they compete against each other, and that should drive prices up and yield down. And as you pointed out, Mark, that isn't what we're seeing. We're seeing prices coming down, even though capital flows towards it. So yes, the interest rate markets, we're not really marching to the typical drum that we look for in that relationship, and neither did gold. At the beginning, it didn't respond to a normal thing. And we have uncertainty, as we talked about. Is that what's causing this breakdown? Is it a short-term point of view that we're seeing that's causing this breakdown? And the fact is, we don't know. This is not typical. And so it's a shock to that market as well. And to me, if you look at the 10-year notes, and I'm talking about futures, I'd be looking for a sideways move. I was looking for a decrease in price today for yields to maybe kick up a bit. That hasn't happened. Yields did get a bit weaker. They are right now. I should say yields got a bit stronger right now, and we're seeing price coming off. But I'm looking for a sideways move for Friday. In other words, people say, I need to take a breath. And I think going into the weekend, we're going to see more of that kind of behavior unless we get something new from fundamentals that will cause an increase in volatility. And right now, are we going to see some positive earnings? I think so. But remember, that's based on history. And so I don't see that creating a huge amount of volatility. So the 10-year notes, it's really a bit of a mystery from an economic point of view. And it's interesting, you mentioned you were starting out in engineering. That's my degree, engineering and an MBA in finance. And you're right about those relationships, Mark. We're not seeing it march to the typical beat of the drum that we look for.
Well, our chat is looking for a lot of things out here right now. Like I said, I could squeeze in some options activity, but I want to make sure. I know a lot of people have a lot of questions, and all these markets are just going crazy right now. So let's see if we could try to squeeze in as many as we can on the show list. And I see some folks, Frank mentioning in the chat that gold hitting another new all-time high today. Yeah, we were talking about precious yesterday with Carly. It is going wild out there again. I'm looking at the numbers right now. So I think we'll head out into the metals next.
wolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, everybody, welcome to the metals. Again, we're not going to spend a ton of time on the options paper this week just because there's a lot of products I want to try to squeeze onto the show. If you want to find it for yourselves, go to that drop down, go to metals, which is at the bottom of the list, and we're going to go precious and gold. And man, gold is lighting it up. Frank is correct. We did hit multiple new all-time highs today. It looks like coming into the start of the show, we were at 31.92. Dan, it doesn't seem like that long ago. Everyone was wondering, can we break 3,000? Can we break 3,000, right? How long? That level held forever. Now, bam, that's a distant memory, Dan. We're looking at 3,200. So new all-time highs pretty much every time you fire up gold, it seems like. So 31.92 when we kicked this off. I think we got up to 31.94 intraday, something like that. So new all-time highs across the board. And gold options volume reflecting that. 678,000. I'll have to go do a historical search. That is the busiest I've seen gold options in quite some time, maybe ever. I'm not going to say that definitively, though, because I haven't gone and looked at the numbers. And whenever we look at gold, usually it's around 220, 250. Maybe on a hot week, it's getting up close to 500,000 contracts out there, listeners. But 678, I can't recall another time on this show where we've seen that much paper this soon. There could be a few odd lot moments I'm forgetting. I will go dig to make sure. But that's certainly up there. If it's not number one, it's definitely top 5 in terms of most active days. Really quickly, if you're wondering what is the most active, then I'll let Dan hold court on the metals. It is the June 3100s, listeners, going up about 16,000 times this week. Again, we're at 31.92, so those are deep in the money calls, which is unusual for gold. Usually we see a lot of out-of-the-money stuff. Also, 2,900 puts in May, 14 days to go, going up about 1,300 times this week. So maybe paper selling those. That, if past is prologue, they are. If you want a little bit farther out of the money, how about Dees 3,500s trading about 10,000 times this week? That sounds more like it, Dan. That's the kind of gold I think we've all come to know and love. But that said, Mr. Dan, it's been wild times in the shiny stuff. We've had a few people on the network of late taking a dim view of the precious metals, gold and silver in particular. Looking pretty good on the silver side. That's kind of been falling out of bed. But as you mentioned with gold, not so much. Gold setting new all-time highs seemingly every day. Record inflows into gold funds this week, or I think it was last week, something along those lines. So just new records across the board. Dan, what is catching your eye in the king of the shiny stuff, sir?
Well, on the gold side, it's behaving to expectations. And I say that because we have so much uncertainty out there. We saw the stock market falling out of bed, and we're seeing some positive action really over just the last 2 days. It's late to the party, the way I look at it. This market, you would expect it to be stronger sooner than what we're seeing here. What's also interesting is before it broke to the downside, we had 3 days down. That's an old Japanese candle pattern. Actually, it's a very old one. But anyways, before it started, somebody was selling gold, and that started on the 2nd, on Wednesday, April 2nd. It made new highs on selling. The next day, sold it. Next day, sold it. Next day, sold it. And then now we're at Tuesday, April 8th. And what we see is what I call a false sense of security. The market got positive for the first time in 3 days, and then it broke down. It was weak. The positive part of it is an indicator that there may be a change in character. So I think gold really began its journey to the upside on a potential bullish signal, which I call false sense of security, on Tuesday. So Wednesday, we got some follow through. We had all the stuff going on in the stock market. Today, we're seeing this market firming up, finally, because I do think it's late to the party. If we think about fundamentals that's happened over the last few days. Now, expectations would be for this market to go to 3,300, that people are going to be looking for that kind of number right now. And they're going to look for follow through. And we are seeing capital flowing towards this market, as you pointed out, all the different choices we have with gold, from GLD ETFs to the futures market. We're seeing capital flowing into it. And the issue is, though, what you don't want to do with gold is you don't want to go vertical. So let's say, in other words, we wouldn't want to go from 3,100 to 3,300 in one gulp. We don't want to go vertical. If we do that, it's very difficult for a market to sustain that. You want to move around a 60 to 70 degree trend line. That kind of movement, that's sustainable. And right now, we have what's referred to as a V bottom in that market. And typically, the second leg, which is what we're in a V bottom, would be longer than the previous leg going down. So this does imply follow through. It just, we don't want to go too far, too fast, too quickly. That would be a different message to us, I think, if we're on the long side. So how it moves, I think it's going to be important. Yes, it is positive. Yes, expectations are very high for follow through. You're right, Mark, that 3,000 was the magic number everybody was looking at. And finally, we got through it. And we didn't do it enthusiastically either. But you know, when you have a major level, it's that old saying on the floor that first time up is a fade, second time's a go with. And we're seeing that kind of behavior previously in this market. So now it's going to be interesting. It's not just today or tomorrow, but it's the next 3 trading sessions, I believe. By Tuesday of next week, we should get a better feel for how strong is this gold market, which has a total different character than what you and I would see in silver. But shall we stay here with gold for a minute? I don't know if you want to talk about silver.
Oh, silver is one that's been brought up a lot. Let me just really quickly, I was trying to dig in some numbers while we were talking to get the historical context for gold. That's hard to get an exact number for CME. I'll have to dig a little longer. I was able to look really quickly at its counterpart, its sibling, which is GLD, which we all know is very much the proxy for gold for a lot of people out there. And on the options front, yesterday was the busiest day it's had, 774,000 contracts. Today, right behind that, 629,000. So we're in the 99th percentile. So certainly yesterday and today, very active on the GLD front. That obviously has to carry over out there in CME land as well. So I would not be surprised if this is the most active week in gold options history over there at CME. But I do want to dig a little bit longer to confirm. But I'm glad you brought up silver as well. That's been a big talking point, Dan. Kind of a surprising one. People not really flying to the second tier of quality that is silver. In fact, they've been crushing it. What are your thoughts on silver's performance of late, sir?
Well, you know, there's just one more thought for gold. Tomorrow's Friday. Tomorrow's going to tell us, how do people want to go home over the weekend? Because Saturday it doesn't trade. Most of Sunday it doesn't trade till 5 o'clock Chicago time. Then it starts to trade again. So are people confident with gold that tomorrow, Friday, we have a positive close, that it closes above right where it is now? If it would close above 3,200, something in that range, does it give us that kind of close? Or does it make new highs and then close back towards the open? Not a sign of confidence. Now, let's talk about Mr. Silver. Silver fell out of bed just like gold did. But we're not seeing the market respond to it. The thing about silver, and you know, gold has this as well. They both have an industrial component. Although in gold, it's a little bit less because it's more of that speculating. In silver, we have, solar panels and other things that are constructed using silver. And if the demand goes down because economies don't do well, the expectations demand for silver goes down. But what's interesting is we don't see the enthusiasm for a market that can be more volatile than gold. Silver can lead the dance sometimes, and we're not seeing that now, and we're not seeing the recovery from it. So should that make us suspect of what we're seeing in gold? I mean, gold does have some momentum. We are seeing capital support, and we're not seeing it in silver. It's very interesting in that regard. And copper's behaving unusually too, although it's a base metal. But staying with silver, we're just not seeing the level of commitment we see with gold. So the bias for silver is actually for another move to the downside, which is interesting. What we need to see in silver, if you're looking at that market, I believe, is that we want to get above $32, and we want to do it within the next two sessions. If we don't get above $32 within the next couple days, I'm looking for a sideways market here in silver. So the next couple of days are going to be important, because if they're not, they are dominated by the price action that we saw last Friday. Last Friday, this did break to the downside dramatically. And then on Monday, we had that transition type pattern, which implies a balance. But it's fascinating to me to see what we're seeing here. So yes, it's a little stronger today. Nothing to write home about. The next 2 to 3 days are going to be very important. We want to be above $32 if indeed this is going to be a bullish move in Mr. Silver.
All right, really quickly going back to the gold options, I was looking at the chart here for, it looks like mostly this year, so this only goes back this year, but the most active day was actually in single days was last Friday, the 4th, 218,000 contracts on the tape. OI hit 1 million that day as well. Looks like this week on the 7th, we hit about 175,000 and 169,000 so far today. So we might even eclipse if this keeps going, we might even eclipse the paper from last Friday, and certainly looking right now like it is the most active week we've had out there. So just a little bit of extra data. Dan, we're coming up against it. I want to try to squeeze in one more complex for the folks, because I know there's a lot of questions out there. You get to choose, sir. Where should we wrap up this week?
Gosh, there's so many. Well, did we do energy?
We did not. So let's head out there.
Yeah,
really
shall
quickly.
we? Yeah, take a peek at that.
Let's take a peek, listeners, to energy. We go.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, listeners, let's do the dance. Let's go out of that drop down, pop out of metals, go up to the third slot from the top to energy. We'll kick things off in crude, because crude has been making the headlines of late out there. Listeners, the impact on demand, what OPEC, has been up to out there, hanging out just slightly north of the 60 handle right now. Not that long ago, a lot of people were saying, man, if we break 65 to the downside, look out below. Hanging out about 60 and a third right now. Is there paper in WTI this week? Yeah, there's paper for days. This is just a kind of a record-setting week, it seems like, almost across the board. And if it's not the absolute record, it's pretty darn close. 1.4 million contracts going up in WTI right now, listeners. So just absolute tsunami of paper. The big dog out there right now, it's the double puts, the 55 puts, going away in just 6 days in May, trading 51,000 times this week, listeners. Followed by number 2, the 50 puts, the June 50 puts, going up 42,000 times. And if you're wondering, does that mean there's a bid to the puts, bid to the downside? Heck yeah, nearly 15% bid is the skew in those May puts we were just talking about. The calls, about 12% discounted, so no love for the upside in crude. And really quickly, let me hit nat gas because I'm sure that one's a banger out there as well. Then we'll let Dan give us our thoughts. Yeah, if crude's at 1.4 million, you're scared to think what the hell nat gas is at. Nat gas closing in on 2 million contracts already. 1.82 million contracts hitting the tape already in nat gas. So again, historic markets we're all living through together, listeners. Nat gas about $3.50, off about 30 cents so far this week. The big dog, again, is May. Looks like it's the 3 puts in May going away in about 15 days, going up 66,000 times this week. And it looks like the skew is actually mostly flat in that near-dated contracts. If we go a little bit farther out, let's go out about 75 days. Now we have the calls bid, about 7% bid, and the puts 6.3% discounted. But Dan, don't let me delay you any further, sir. What is catching your eye in the wild energy markets right now?
Well, when it comes to crude oil, I was looking for follow through. Yesterday, we had a nice break to the downside, kissed 55, and it bounced. It implies that they were buying the break there. And it's a logical level for us. If you look at crude oil, especially in $5 increments, it has a $10 kind of trading range is more typical for this market. We have a lot of supply out there. That's a bottom line. And if we're going to have all these doggone tariffs and that slows down manufacturing because people aren't going to be buying like they normally buy, that means demand for crude oil goes down. And if China slows down a bit, they're the largest importer of energy in the world. So yesterday, I thought, are people hedging at this level? There are some organizations that my path crosses that I could see them hedging, just locking in lower prices. However, today, we don't see that confidence. Just like the stock market that you and I looked at, we're seeing some selling coming back into crude oil. So we're not seeing the confidence. Here's the issue, though. Let's think about production in the United States. If you're a shale producer, you want crude oil around $70. There you're profitable. If you look at the Middle East, they want it around 80. Saudi Arabia like it around 100. So right now, marginally, from a profitability point of view, if you and I are a crude oil shale producer, this is not friendly to our bottom line. And if we look at nat gas, I thought nat gas may have a chance to get a bit of a rally going. Again, we have a lot of supply. We've had a change in weather predictions right now in the United States and being a little bit warmer. So it means we saw a little bit of softness today in that market. I'm looking for an inside day tomorrow. There's no strong reason to see a big drop in that market. Same thing with crude. So I'm looking for sideways movements in both of those markets. I don't look for a big day up, but if we think about the chatter out there internationally about what can we buy from the States that's easy, nat gas is easy in a sense. So I think longer term, it's a market you and I want to pay attention to the upside, because I think there could be an influx of demand over the next few months in nat gas. We're not going to see it today, but longer term, I think it's one for us to keep our eyeball on.
Well, Dan, that music means we've come to the end of a jam-packed show. Man, we hit on everything. Just really kind of the ags and FX, maybe the only two things that slipped out of our radar today. But those two, FX moving a bit. Ags not exactly dominating the tape, so they could fall by the wayside a little bit this week. But Dan, an epic show. Well done, sir.
Well, thank you very much, Mark. Always great to be with you. Thank you.
Our audience enjoying it, all the chat saying good. They say it was jam-packed with good stuff. Lots of food for thought. So there you go, Dan. Our audience liking it. And as we're winding down here, if there's any last thoughts you want to leave folks with, maybe a couple of complexes we didn't talk about, you have a comment or two, have at it, sir. The floor is yours.
Okay, well, when it comes to, we didn't talk about currencies. The currencies really are screamers. The dollar is weaker across the board in all these currencies. I mean, if you even look at resource-based economies like Australia, New Zealand, Canada, we're seeing some strength coming back into those markets. Japanese yen, that's a very interesting one. It's struggling, but it's positive today. The market, the currency that really took off is our friend, the Swissy. The Swiss franc really is leading the pack when it comes to those 6 currencies that make up the dollar index. And the ags, what's interesting there quickly, beans, corn, those markets are moving higher based upon projections for yields for what we're planning here in the United States, for weather conditions looking forward. So those are relatively positive based on some government reports. The ag that's really lagging behind is Mr. Wheat. That one globally, we have potential for a lot of supply. If you look at Russia and Ukraine and their ability to transport their production, that's looking pretty good globally. So a sideways move here, continuing of a sideways move, I think makes sense.
Mr. Dan, well done as always. And if folks want to check out all this stuff outside of the times you're joining us here on the old TWIFO program, where should they go? What should they do, sir?
Well, I do have a website, dangramza.com, and I produce a free daily video that I grab. I look at 22 markets, which I covered in an advanced video. And there's also a course there that talks about the techniques that I use and the trade management concepts that I use. There's a list of topics there that somebody could take a peek at and see if that's of interest to them. The free video, I grab different markets to take a look at. You're going to see red and green lines. Green means buy, red means sell. Dash line means it was something that happened earlier in the week. These are not buy and sell recommendations, but I just want to show you how I view those markets. So if you haven't looked at futures, it may be a place to start, and that is just to watch them. And again, you can go back 10 years and see, okay, what did he say the day of the tariffs? Or what did he say when this happened? What was he showing? And you can go back and do that as well. So just another potential resource.
There you go, listeners. Check him out. DanGramza.com, the place to go to kick the tires and light the fires. That's going to do it for us on the network today. Hope you're keeping your head above water. Hope you're making some money out there, at the very least not losing some. These are wild times we're all living through together, listeners. We asked our audience at the start of the option block today. There's a lot of madness going on out there. Are you folks still slinging 0-day options in this, or is this just way too crazy for you? And right now, listeners, 83.3% saying no way they're touching those with a 10-foot pole. 16.7% saying they're still trading them. Those are the hardy few. Certainly fortunes to be made or lost out there, but it's not for the timid. So be careful out there. See you back tomorrow for Vol Views. Going to be another banger. I got a feeling our buddy the Loggins will be joining us on the show. So look forward to special guest stars. He had a little bit of, he'd like to hang out in the green room a little bit last week. We'll see if we can get him out a little earlier this week. And then, of course, after that, head on over to the theoptionsinsider.com/pro to join us for Options Oddities, another banger one on the docket this week. Then we're back again on Monday for the option block all the way through to next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, Visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.